Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 287 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Good morning, Matt.
Morning, Mark. How you doing, buddy?
Good. How are you?
It's been busy the last couple of weeks. Earnings season, lots of headlines in the news.
Yeah, there's been no shortage of news. As we were just chatting off air, we have quite the content back up in our emails for future podcasts, which is a good thing.
Yeah, we're definitely not scraping the bottom of the barrel. We are actually picking through some good content and selecting what we want to tell our listeners and viewers.
Yeah, that's great. So we'll get into that here in a little bit, but as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts, and as of the market close on February 6th. S&P 500 index up 0.7% for the month and up 3.4% for the year. The Dow Jones Industrial Average up 0.5% for the month and up 5.2% for the year. The NASDAQ Composite Index up 0.8% for the month and up 2.5% for the year. The small cap Russell 2000 index is up 1% for the month and 3.5% for the year. And the Vanguard All World Ex United States ETF up 1.3% for the month and up 4.7% for the year. 3-month Treasury rate at 4.34%, the 2-year Treasury rate at 4.21%, and the 10-year Treasury rate sitting at 4.45%. Moving on to big headlines and current events from the past week. Over last weekend, President Trump announced tariffs targeting imports from Canada, Mexico, and China, citing concerns over illegal immigration and drug trafficking. These tariffs were set to take effect on Tuesday of this week. And it was outlined that a 25% tariff would be imposed on most imports from Canada and Mexico. However, Canadian energy exports, including oil and natural gas, were going to face a reduced 10% tariff. And he also announced that a 10% tariff would be applied to Chinese imports. However, following discussions between President Trump and Mexican President Claudia Sheinbaum, Mexico agreed to deploy 10,000 National Guard troops to its northern border to combat drug trafficking and illegal immigration. The U.S. has postponed the implementation of tariffs on Mexican goods for 1 month. And in addition to that, the U.S. has postponed the tariffs on Canada by a month after Canada's commitment to bolster border enforcement and combat organized crime, fentanyl smuggling, and money laundering. So I think it's good news that tariffs have been delayed for now, at least. And again, I think we've talked about this before. I feel like this is more of a bargaining chip for him than anything else. And again, this isn't the first time we've seen this with President Trump, because we had 4 years of this. We actually, I just created a chart that showed, a lot of the major tariffs that were implemented in between 2016 and 2020 when it was his first term in office, along with a chart, the S&P 500, and the market still did just fine. We can't crater to news headlines just because other people are saying it's going to be a bad thing for the economy or a bad thing for the stock market. We have to keep in mind that the media is trying to get clicks, and the more juicy the headline, the more clicks that they get.
Absolutely. It's a good way of saying it. We talked about this on the podcast with Trump coming into Inauguration Day on January 20th. We were talking about expect these news bombs is what we called them. And we got to remember that, a lot of this immediate trading done by Wall Street, a portion of that's done by computer-driven trading. And that computer-driven trading is only good as the people that program those trades. And in my opinion, they're really not set up to take into account Trump's style of negotiation, right? He's not, I'll use the parent analogy. I know it's a little loose, but it's going to make sense. Instead of the parent saying, hey, well, if you do that, then I'm going to take this away. He takes the toy away and says, if you want the toy back, I want you to do X, Y, Z. Mm-hmm. And I just don't think a lot of these computer-driven programs that Wall Street utilizes are set up for that type of news headlines. Mm-hmm. And they take everything as if it's written in stone, and that's obviously not Trump's playbook, which is causing a lot of this volatility you saw over the past week, which we talked about was most likely going to occur.
Mm-hmm. Yeah, for sure. Turning away from the tariff news, some earnings-related news from FactSet. As of February 3rd, the percentage of S&P 500 companies reporting positive earnings surprises is above the 10-year average, but the magnitude of those earnings beats is below the 10-year average. They said that 36% of companies in the S&P 500 have reported so far. Again, this is as of February 3rd. And 77% have beaten expectations. That number is in line with the 5-year average, but above the 10-year average, which is 35%. The index is reporting its highest year-over-year earnings growth rate in 3 years. So
that's not bearish.
So far, so good.
That's not bearish.
I think from a lot of these earnings. Now, the earnings report is different from the stock reaction after. And I think over the past week, I've seen a lot more negative reactions to the earnings calls. But again, it's just the environment that I think that we're in right now, with a little bit more volatility coming back and some more news that the market's trading on.
Yep, I think it's well said.
Moving on to tweets, articles, and research from this week. The first thing I had was a blog post from Ryan Dietrich on January 31st titled, "As Goes January, So Goes the Year. The Bulls Hope So." So he says, and again, we've talked about this indicator on our podcast before. An effect widely known as the January barometer looks at how the S&P 500 does in January and what it may mean for the next 11 months. It is known by the saying, "So goes January, goes the year." In the media, the late Yale Hirsch first presented the phenomenon in the Almanac Trader of 1972. Historically speaking, when the first month was positive for stocks, the rest of the year was up 12.3% on average and higher almost 87% of the time.
Not
bearish. And when that first month was lower, stocks were up about 2.1% on average and higher only 60% of the time. So
pretty stark stats.
Pretty stark stats. So January is the most predictive month when it comes to seeing what the next 12 months are going to be like for the market.
Yeah.
More so than any other month in the calendar year. So we did just have a positive January, which by the data that I just went over, I think is a very good thing for investors. Should have bulls smiling. So again, is this stuff guaranteed just because we had a positive January that the rest of the year is going to be great? Of course not. There have been years where January has been positive and the rest of the year has been negative. Yep. But again, I think it's just important knowing that we do have history and the data on our side right now. So I think it should at least give us some level of comfort that there is a higher probability that 2025 will play out nicely.
Yeah. And again, I'm in the camp. Expect more volatility, though, along the way.
Mm-hmm. Correct. Next thing I had was a post on X from Ryan Dietrich. This was back on January 23rd. And this will be up on the YouTube page and in our show notes. Ryan says the S&P 500 was up 0.62 the first 5 trading days of 2025, which could be a good sign for the bulls. When those first 5 days are higher, the full year is up 14.2% on average and higher 81.3% of the time. Both are better than your average year of 9.5% and 72%. 10%.
That's not bearish.
So again, in addition to the January barometer, another one that we look at is how the first 5 days of January are. And if they're positive, it increases, again, the likelihood that the rest of the year is going to be positive.
Yeah, through the lens of history.
Again, we had the first 5 days of the year that were positive. The first month of the year was positive. The Santa Claus rally was negative. So that's, what the Hirsch family calls the January trifecta is the Santa Claus rally, which is the last 5 trading days of the year and the first 2 trading days of the new year. So that was negative, but the January barometer and the first 5 days of January tend to have stronger correlations or stronger probabilities than the Santa Claus rally. So again, full disclaimer that this does not mean that 2025 is going to be a banner year, but I think the odds are there, and it's set up for us to have a pretty good year, obviously without its volatility, like you said. But I think it's just helpful as we go through the year and we see all of the scary headlines in the media, or we get a sell-off or a correction of 10%, is to go back to data pieces like this and say, hey, the probability is still on our side and things still should end up pretty good.
I have not a single thing to add. You said it perfectly.
Great. Efficient. Moving on. Post on X from our friend Seth Golden on January 19th. He says, boom, that just happened. The S&P 500 with 4 straight days of at least 70% of stocks advancing. Since 1990, when this occurred, the market was higher 6 and 12 months forward 92% of the time. Average return 8.7% and 10.6% respectively.
That's not bearish.
So the reason why I bring this up, again, he said that S&P 500 had 4 straight days with at least 70% of stocks in the S&P 500 advancing. That's what we call strong market breadth, where a lot of the companies are participating in the upside. And again, we have to remember that the S&P 500 index is a market cap weighted index. So the larger the company, the higher the weight. So at the top, you have your heavyweights of Apple, Amazon, Microsoft, NVIDIA, Tesla, Google, etc. And the smaller companies are at the bottom. And typically the top 10 to 20 names in the S&P 500 mean a lot more in terms of returns than the bottom 50 names.
They move their weight around, pun intended.
Correct. So, but it is nice to see a lot of stocks participating to the upside, because we have seen several periods over the past 5, 6, 7 years where it's just been these mega cap tech names dragging the index higher. And really, under the surface, most of the names in the S&P 500 were performing poorly. But this is a good sign of, again, what we like to call market breadth, meaning there are a lot of stocks participating to the upside, which is a good thing in general.
Did you look at my show notes?
I did not.
Okay.
I did not. But
I will
I'll turn it over to you.
Complement this perfectly. Are you ready? So I saw this piece from Tavi Costa. He is a macro strategist at Crescent Capital. And he had this post, let me get the date, February 5th. February 5th, Mark. And what this illustration is, Jenna will put up this chart for our YouTube viewers. This will be in our show notes and all of our social media sites. He breaks down the S&P mark by sectors of the market and their performance year to date. And it's leading to this narrative that you mentioned about market breadth, about what sectors, how they're doing so far to start the year. And it's surprising because when you look at this data, technology is the largest component of a sector within the S&P 500. And what do you notice through this data that Tavi has through February 5th? It's down about 3% year to date, okay? But then you look at these other sectors, and I'm going to say it kind of this way, that have kind of been left behind the last couple of years, haven't performed great in general. And you're seeing a lot of these sectors, they're up anywhere from 2 to 7% year to date. And One thing I mentioned when you weren't on the podcast a couple of weeks ago, I quoted the infamous Mark McEvely by saying, sector rotation is the lifeblood of a bull market. Am I true or false?
True.
When you see this type of sector rotation, where the leader the last couple of years is taking a little bit of a short-term break since, say, the end of November, that's not bearish from my perspective. Because if you constantly have, let's take tech as the example, being the only one who's dragging it up, as you mentioned just a couple of minutes ago, that's a problem in my opinion.
2000.
Right? It's a problem. Mm-hmm. When you see this type of sector rotation, that's not bearish. And there could be listeners right now on our podcast that might be light in certain sectors, such as tech. And you guys and gals might have been waiting for an opportunity to get into the sector. Guess what? You're getting some pitches. It's up to you whether that allocation to tech is in line with your goals and objectives and risk tolerance. But if that's something you're seeking, tech's down 3% year to date. You can't call me up in July or August and say, oh, well, I didn't know that I had an opportunity. Mm-hmm. You get an opportunity if that's in line with your risk tolerances.
Yeah, for sure. So it's definitely good, and I would even say healthy to see the rest of the other 10 sectors in the S&P 500 start to pull their weight up a little bit so far year to date.
I like it. So my next piece is going to be a little bit of education. You and I are going to have a fun roundtable about this. I'm not poking the bear. Some of our regular listeners know once in a while, Mark and I do a good job of knowing each other's things that really get to us, right? So this is in lines of reasons why a company would buy back its own stock. Now, this is a piece from Brian Fernaldi. Brian has a very popular blog post that he posts a lot of content. And he posted this piece from Smart Money. And I don't think it's a recent piece, by the way, for the record. But it's applicable to this conversation because a lot of times clients or investors, Mark, might question, what could be some of the motivations for a company to buy back its own stock? So let's go through these. This article has a couple different topics. I'll go through them in order. First is to bolster the stock price. The article says repurchase programs tend to place a floor under the price of most stocks. That's because there is now a larger buyer in the market. However, corporate assets are being used to prop up share prices. If management were to allocate those assets in more productive ways, perhaps the share price would not need bolstering. I think of a couple of companies, I won't name specifics on the podcast, that have been habitually buying their stock back the last decade. And if they weren't doing so, they actually would have negative growth in their EPS. But that's for a different story.
Yeah, and I think a lot of, not specifically tied to this, but I've had conversations over the past year with people about this is, when you get a stock that has a share price of $800-900 or $1,000, people immediately think, well, that stock is overvalued. And you can't just say that just looking at the share price. You have to dig into the fundamentals because maybe it is justified by strong earnings and revenue growth,
well said,
for
Mark.
example, right?
Well said.
So you can't just look at the price of a stock and nothing else and make a determination if that stock you feel is undervalued or overvalued. It's expensive, maybe to you, but to a Berkshire Hathaway, $1,000 price per share is fine.
Great point to throw out there. And you could always take the opposite end of that angle. Just because a stock is trading in the double digits, say $50 a share, doesn't mean it's a good
Undervalued,
value.
yeah.
All right, so the next one is to increase book value. Book value is calculated by subtracting total liabilities from total assets. The book value per share will rise in a stock buyback, but only if the price paid for the stock is less than the book value per share. Next, increase earnings per share. I alluded to this a couple minutes ago. Earnings per share will rise due to the stock buyback program. For example, XYZ company, which trades at...
That's interesting. Yeah, and we always use this all the time too now, right? XYZ company.
I can't do that anymore, can I?
XYZ is actually a ticker symbol now.
I can't, yeah.
Formerly Square.
Which
block.
is now you block.
XYZ is the ticker symbol.
Thank
now,
you for that
so.
disclaimer.
Yeah.
For listeners and viewers, this is a fictitious
Yes.
XYZ company. So, for example, fictitious XYZ company, which trades at $40 per share, has $100 million in annual profits and 50 million shares outstanding, has earnings per share of $2 and a price to earnings ratio of 20. The company, which is cash rich with $125 million in the bank, buys back 1% of its stock at $40 a share. That's 500,000 shares at 20 million. As a result, the same profit of 100 million is now spread over 49.5 million shares, boosting that earnings per share from $2 to $2.02. In effect, the earnings went up by 1% and in the same percentage of the reduction of the numbers of shares. So there's more that go to that. You're also eliminating the dividend when you retire those shares. But that's definitely a motivation for companies to put that cash to work, return it to shareholders, make that ratio a little bit healthier.
Yeah, and you just have to understand this type of stuff if you are looking at financial statements or trying to evaluate a company based on its fundamentals, is going back and seeing if companies have bought back their own stock or if they've had stock splits, because that will affect the numbers and the growth in margin, revenue, earnings, etc.
Yep.
And I know a lot of the pieces of software out there today adjust for those type of things, but you just got to make sure that you're reading that correctly.
Yep, well said. 3 more. Reduce taxes. The tax issue might persuade some to prefer stock buyback programs over dividends, but it does not address why the corporations or the investor would prefer stock buybacks over the alternative investments that could earn higher returns than a stock repurchase. Next, employee incentive options. Often companies run out of stock to award as employee incentive options. If the company's buying back its stock at market price to sell to the manager's pool of employee incentive options, it might make a convincing argument. But it's not. This is what the article says. Shareholders can always authorize additional shares at the next annual meeting. And the last point it shows in this article that Brian posted is hostile takeover protection. Cash-rich companies are target for takeovers. Stock buyback programs reduce cash, thus making the corporation less attractive, enough said, period. So I thought it was nice just to kind of cover that. I think we've had, over the years, get questions from clients and investors. Hey, why does a company buy back its own stock? What could be some of those reasons? A post by Brian, caught my eye, and I wanted to share it.
Yeah, and I think the most simplistic kind of wrap up of it is, at the end of the day, when companies are buying back shares or retiring shares, it's taking supply off the market, which theoretically, if demand stays the same, should boost the stock price. But me and you both know that demand for a certain stock isn't always the same or always linear.
Yep.
And that always is going to change. So, you will have instances where companies buy back shares and 1 year later the stock price is actually lower than where it was trading pre-buyback.
It's by no means guaranteed that the stock performance is going to be good, positive, or outperform the market. That's important to throw out there. I'm glad you said that, Mark. The other kind of thought that comes to mind is, it takes cash to buy this stock back, right? So you're not going to have traditionally a company that has negative earnings or is bleeding money every quarter buying back its own stock. You tend to not see that, right? And for companies that pay a dividend, you buy that stock back, you don't have to pay that dividend anymore. So there's an aspect of some cost savings from that lens as well. And it might allow them to raise the dividend proportionally. You retire 10% of the shares, you might raise the dividend by 10, and you're kind of equal money, right?
Right.
So there's definitely some things there that I think make sense. All right, my last piece that caught my eye is, I'm going to term this, don't fight the trend. Okay, I'm going to call it that. And this is a post from a technical analyst called Frank Caparelli. How'd I do there, Mark?
Not good.
Okay.
Not good.
Jenna.
No, I think you did do good, actually.
I'm losing lift on that pronunciation.
Frank Capillari. Capillary?
I got close.
Capillary.
And Frank, if you listen, I apologize, my friend. But good post.
The cap thesis is easier to say.
There we go. So Frank posted this, and it shows the S&P 500 index patterns. He says, quote, patterns are everywhere if you look close enough. So Jenna will put up this chart for our YouTube viewers live on the video. This will be in our show notes for our traditional podcast listeners. And Mark, what you're going to see is roughly a 1-year chart of the S&P 500 index. And what Frank has done here is he's identified kind of this pattern that has developed over the past year of what I like to personally coin 2-step forward, 1 step back for the market. So for our traditional podcast listeners, what I want you to envision in your mind is this chart that kind of takes 2 steps forward, and then we kind of take 1 step back. We sell off a bit. 2 steps forward, 1 back, and picture that in your mind. Stair-stepping higher, zigzag higher.
Yeah, and another way to think about it is, in the 2 steps forward and then the 1 step back, think of it as, a 1/3 pullback of the move that was higher. So
Well
you get
said.
this zigzag function. It's not going to be perfectly linear like that
Every
all the
single time.
but
that's the general pattern. And so, what you're seeing is, yes, the market is stair-stepping higher, but not without volatility. And my point in bringing this up to listeners and viewers, Mark, is to coin it, don't fight the trend. Are we going to have periods of sell-offs? Yes. Are we going to have periods of uncertainty that question the validity of the uptrend that began in Q4 of 2022? Yes, that's not going to change. But until this is dramatically broken, this overall trend, my 2 cents is, if you have a long-term investment time horizon, don't fight the trend. Your comments.
yeah, it's just it doesn't usually doesn't end well for people that try to pick tops and pick bottoms. It's virtually impossible to do. But what you want to do is just capture the main meat of the trend, right? So you're not necessarily buying the bottom or selling the top, but you are participating in that trend.
Well said.
So, and over the past 1.5, 2 years, obviously that's been higher.
And one thing I've noticed, kind of going back to the piece you were talking about, market breadth, what I notice is when it takes this step back, this 1/3 sell-off, traditionally the air tends to come out of the more aggressive areas of the market, or it comes out of areas of the market that have performed well in recent history, say over the past 12 months. So when you look at the data point year to date that I quoted that showed, say, tech, for example, down 3%, that doesn't surprise me, right? And so if the trend continues, there is some statistical probability, in my opinion, that if the market makes another advancement, you might have money flow back into tech. Is it guaranteed? Absolutely not. Don't make an investment trade based upon what I just said there. But I think the likelihood, in my opinion, I think it favors it, but we'll see. And I'll be curious to see how that plays out over the next couple of months.
Yeah. No, I've been following Frank's work for quite some time, and obviously he posts updates to this specific chart that you're talking about. That's been going on for several years now. So, glad you brought it up.
Yeah. I mean, again, it was really tough this week, wading through all the content I had and just trying to make things as not actionable, but just real time as possible to the data that I think will give insights into perspectives about the market that's not really being talked about in the mainstream media.
Yeah, well said. Anything else before we leave it there for the week?
We're starting to wind down earnings season, right? Got the employment report past us. I think you might start to see news flow outside of maybe political related headlines start to slow down over the next couple of weeks. So that's just kind of my main comment is we're getting kind of past the peak of Q4 earnings season.
Yep, agreed. All right, well, thanks everyone for listening to episode 287 of the Independent Advisors Podcast. We will be back with you next week for episode number 288.
We'll see you next week, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.